Good old stock options. Everybody has an opinion on them, but most people lose money with them. So, in this video, I'm going to break down how I make over $30,000 per month on average with stock options in a low risk way in my 7 figure account. It didn't always start out easy though. I'm going to be honest with you guys, like it was a struggle to get started with stock options. But over the course of the last decade, I've learned a lot of hard lessons, a lot of sleepless nights, a lot of blood, sweat, and tears, a lot of books I read, seminars I went to, mentors I paid, courses that I did to learn what actually works in stock options. This video right here is going to transform how you see stock options and how you plan on doing them going forward for the rest of your life. Because options are number one, a way to make money, but they're also a way to generate cash flow on your account. So if this is the first video that you're watching in this series, this is video number 3 of 3. There's 2 videos that came before this one, basically telling you how to build your portfolio, how to make more money at your day job, how to beat the market in the long term just by building your base portfolio. And then now we're here to do stock options in a low risk way, in a way that just simply works in a bull market and a bear market. It's honestly going to be like, why didn't I think of this before? All right, so I'm pretty excited to go through this video with you guys here because honestly, like, this is good stuff. Like, a lot of people use this strategy. There's been thousands of people that I taught this to, but I'm happy to be able to teach this to you right now. Okay, so there's a couple housekeeping things that we have to cover before we dive into this chart right here. The first thing is this. Again, everybody has an opinion with stock options. Everybody says that they could buy weekly options, daily options, monthly options, whatever strategy they do. But at the end of the day, it all comes down to this. We're going to keep it very simple here. Options are just a way to magnify an expected return. What does that mean, Brandon? Well, if you think a stock is going to go up, if you have a high degree of confidence in that, you could use stock options to magnify that return and make more money. If you think a stock is going to go down, you could also capitalize more on the downside than just like shorting the stock straight up. You could do different option strategies to make money doing this stuff to magnify your return. But if you don't have a high degree of confidence, what way the stock is going to go, you shouldn't make a play on the stock from the get go. But you definitely shouldn't do a magnified bet on the stock, meaning you don't have any clue where it's going to go, like you're going to take a magnified loss. You don't want to do that. That is a dumb thing to do. And I think that lesson right there is like one of the key things from this entire video to take away. You have to be confident in the direction that the stock is going to move. So if we go down to the chart right here and we take a look, this is a chart of the NASDAQ. It's going to be arbitrary. It doesn't matter what stock we do this on. It doesn't matter what time of year you watch this video. This video is going to be relevant forever because human nature simply does not change. Okay, let's take a look at a couple things right here. Let's use this little dip pump right here as a good example. Let's just say that the typical average investor, what are they thinking right now? Like in this time period right here, are they happy? Are they mad? Do they feel like they're making a lot of money? Of course, the market's been on this nice run right here. They feel like they're making a lot of money. So what are they doing in this time period right here with regards to options? They're probably going to buy some call options. They might sell some put options. They probably have a bunch of shares. They probably have a lot of leverage in their account. Maybe they bought some, calls on margin. Maybe they bought some shares on margin. They're probably levered out right here because they just think, hey, the market's going up. They think it's going to keep going up. Like this is how they see the market going right here. They think it's just going to go straight up. But in reality, that's not what happens. The market does take breathers. The market goes down a little bit sometimes. And that's simply why most people get wiped out at the end of the day. Because let's kind of run through this on a flip side here. When this market's going down right here, it went down from peak to trough roughly 25%. All these people up here that were buying calls and leveraging out, most of them got wiped out because this dip right here, this went from roughly December of 2021 to roughly September of 2022. So call it almost a year for this dip to actually play out. This is 1 year of pain for the typical average investor that sold puts, they bought calls, they bought shares. They are just seeing their portfolio bleed down, down, and down. So the average person probably lost way more than 25% because they had a higher, leverage value in their portfolio, higher beta basically. Beta is just essentially volatility. So if this went down 25%, the average Joe probably went down like 50% and they probably got margin called and got wiped out. So we're going to use this to our advantage and let me draw a new line right here. This line right here, as I talked about in the previous video in this 3 video series, this line right here corresponds to the earnings per share growth of the company, whether it's an index, the S&P 500, the NASDAQ, NVIDIA, AMD, TSM, whatever company, it doesn't matter. This applies to every single company. When the stock price is a little bit above what the actual earnings per share growth line is at, this could be a time to be careful because you don't want to over leverage at a time that, hey, maybe the market's a little bit stretched to the upside and it should revert down to the mean line of growth. But the market doesn't just have to revert down to the mean line of growth. It could go down even more. And down here, when most people were freaking out and panicking and trying to get rid of their shares, This was a time to buy calls. This was a time to sell puts. This was a time to buy shares. That's what I was doing. So I used this growth line as a critical way to give me a high level gauge of what I should do in the market with options. To be honest with you, it's very simple. So up here, what were most people doing? Like I said, they were buying call options. So while there's a lot of people buying call options up here, we could say that there's probably a lot of demand to buy those call options up there too, right? A lot of demand because everyone wants to buy them. So when there's a lot of demand for something, the price of that thing is going to go up in price. The call option value is going to go up in price. But you're doing the call option at the worst possible time because things are expensive. There's not much more upside probably to come in the market in that short period of time right here. So while they are buying call options right here, I'm going to sell them those call options for top dollar. I am going to generate cash flow when the market's getting expensive, where I feel like the future expected returns for maybe a year out aren't going to be that good because they're just thinking, hey, it's going to go up and to the right. I'm seeing, hey, the market's a little bit stretched from the fundamentals. I get it that the market does not have to fall right away once we get stretched from the fundamentals, but statistically speaking, the farther that we get away from the earnings per share growth line, the more likely we are to have reversion to the mean and a little bit of a correction. So I'm selling call options for top dollar up here. And again, we're going to get into the bullish strategy here, which is what made me seven figures. Like it's like critical to understand my bullish strategy because it makes a lot of money and it's honestly very, very simple to understand. But before we dive into that, we have to understand why this bullish strategy works. So let's lay the foundation a little bit here. What does every CEO of their company want? What do they want to do? They want to boost revenue and boost earnings per share. Earnings per share is just the profits. As profits go up, the share price is going to go up. Most CEOs are compensated with call options. They basically could just get call options on their stock, and if the stock goes up to a certain price, they are allowed to exercise these stock-based compensation options. So they're all incentivized for the share price to go up. So with that being said, what do we want to do with our option strategy? Maybe we want to align ourselves with what the actual CEOs want to do. And let me ask you this one last question before we actually dive into it. What do you think a CEO would say if you say, hey, Elon, for example, at Tesla, can you make your company more valuable in a week? He's going to say, no, I can't do anything to make Tesla more valuable in 1 week. Hey, Elon, what if you have 1 or 2 years? Can you make Tesla more valuable? He'll say, oh, yeah, for sure. I could definitely do it in 2 years. So when you understand that, it's like if you try to make short duration option plays, you're kind of just gambling because you don't know what the stock is actually going to do in the short term. The true fundamentals of the business cannot really improve in a week. Like sometimes yes, but most of the time no. So down here, while this market is cheap, when everybody is freaking out, this is going to be the time that you want to sell put options and buy call options and buy shares. All three strategies right there are bullish. Now, the first thing that we're going to start on right here is going to be selling put options. And this is one of the biggest hacks to investing that I've ever found in the last decade. And this is how I generate like 30K a month on average. Some months I make more, some months I make less. It really just depends on what's going on. Like up here when the market's a little bit expensive, I am selling less put options because the market's a little bit hot. I want to sell put options down here when the market is cheap. And again, up here, I did a little bit less, and then I did a little bit more right here. Did a little bit more right here too. So I just like this dip right here. It's easy to understand and conceptualize here with you guys. So I'm going to sell right here on, let's just call this the S&P 500. I'm going to sell 2-year put options down here. And you're going to be like, Brandon, you are psycho. Why are you going to go 2 years out? You have to sit on that contract for 2 years. There's no way that you're going to make a lot of money with that 2-year contract. Hear me out for a second. I'm going to kind of like prove you wrong, and you're going to be like, wow, that actually makes sense right now. Here's the thing about that. When I sell a 2-year put contract right here, when I feel like the market is cheap and everybody is freaking out. Again, people want to buy call options when the market's going up. People want to buy put options when the market's going down. The herd just goes with the trend of the market. They just get emotional and they just freak out. So while people are panicking when the market is down right here, they are willing to buy downside protection in their portfolios. They're willing to buy a put option. So what am I willing to do when the market is cheap? I know that the market is well below the earnings per share growth line. I do know that a rebound is likely to come in the future. What am I doing down here? Well, I'm going to sell them the put option for top dollar. So the typical person is going to say, hey, I might sell a put option too. I'm going to capitalize on this dip. But the typical person is going to sell like a 1 or 2 month put option. And the problem with that, let's just run with 1 month for the example right here. Let's just say that they sell a 1 month put option and they generate $1,000 of cash flow. $1,000 for a 1 month put option. Good. The market went higher. You made money. Congratulations. But what did I do? I sold a 2-year put option right here. And instead of generating $1,000 per month, I generated $24,000 right here on the bottom of the market when the market is cheap. Okay. I got 24K right here. The average Joe got $1,000 right here. Both of us are going to make money. You're going to see in the long term, both of us are going to make money. I'm just going to make a lot more money. Why? Because I only have to make one trade at the perfect time in the market. And you have to make 24 trades month after month after month after month after month. You have to hit 24 trades in a row at a time that's going to be less favorable. Like right here, the market's a little bit hot. Right here, the market's a little bit hot. You're not going to be able to sell puts and make money when the market is hot. Right here, the market went down. You're going to sell puts and you're going to have to roll down and out on your sold puts that you did. It's just not going to work. You're going to lose money on your sold puts right here. You're going to lose money on your sold puts right here. So what I did was when the market was cheap, when the stock was cheap, I sold $24,000 worth of put options at the right time. I took that money and I bought calls and I bought shares. Why? Because again, do people want to buy call options down here when the market is falling? Of course not. They are nervous wrecks. They are freaking out. They want to buy put options. They don't want to buy call options. So when the market's cheap down here, I'm selling puts for top dollar because people are freaking out. So I'm collecting the most amount of premium. And then I'm turning around and taking that premium and buying call options for bottom dollar because nobody wants to buy call options when the market's falling. But I do. And maybe that's why I scaled to a 7-figure account. Again, this is only one of my accounts. I have other brokerage accounts that have a lot of money in them too. I just show you guys this account because it's just my main trading account. So with that out of the way, you could see that I am generating the cash flow at the time that the market's cheap, and there's the max point of maximum opportunity to do that. That's when the market's cheap. You expect more future expected returns going forward. So I'm going to be cool with that. And on top of that, the sold puts that I do, like right now on the right side, you could see that it's $326 per share. The sold puts that I could do, I could choose a strike price of like $300 per share. So what that means is I have to buy these shares of the S&P 500, VOO is a ticker here. I have to buy these shares anytime between right now and 2 years out for $300 per share. Of course I want to do that. The companies in this S&P 500 are going to be worth way more in 2 years from right now. And you can see the index went 2 years later, like well into the 500s. So of course, sell me your shares for $300 per share down here. I would love to take them off your hands. And the reason why I bring this point up is because the person that's going to sell monthly put options, they're not going to be able to go that low below the strike price. They're going to have to go like, if it's 330 right now, they're going to have to sell like a 325 sold put, because if you go $30 below for a contract that's only 1 month long, you're not going to generate any premium. There's really no demand for that contract right there. But for me on the other side, I could go farther out, which is safer because these companies have more time to raise their profits, raise their earnings per share. These companies are going to be worth more money. They're going to follow this growth line right here. And on top of that, I have the opportunity to buy these shares at a cheaper price than what you're doing at a monthly contract. Okay, so all that makes sense. And the other thing that you're probably going to say is, well, Brandon, I get it, but you're not going to get as much theta. You're not going to get as much time decay on your contract. Basically, every month that goes by, these contracts go down in value. But when you're selling put options, that's actually exactly what you want. You want to sell something for $24,000 and then you want to buy it back for like $1,000. You make $23,000 profit on that trade right there. But here's the thing about it. Like, we'll just use the Liberation Day tariff dump rate here as a really good example. I was selling put options. We'll just use AMD, for example. I sold a lot of put options on AMD. I did 2-year contracts, and I only held those contracts for roughly 3 months. I held them for 3 months, but my realized profit on those sold puts was roughly 85%. Understand that. I only held those contracts for 3 months out of 24 months, and I made 85%. Why? Number one, the share price went up. But number two, the sentiment flipped. People wanted to pay top dollar for put options down here. But once the market started to rebound, people were like, oh, put options aren't valuable anymore. I don't want to buy put options anymore. I want to go buy call options. So remember, I bought call options for bottom dollar. The sentiment flips and now they're worth more. I sold put options for top dollar. Now the sentiment flips and then they're worth nothing. So that is like exactly how you capitalize on a human emotion of the investor. This is how you make money with stock options. Now, in my previous video in this 3-video series, again, you have to watch all 3. It's going to really help you guys out a lot, whether you're a beginner or, an intermediate, whatever you think you are. Go watch all 3. Trust me, this 3-video series is going to help you out a lot. But in my previous video to this one, I showed you my base portfolio. I showed you my triple Q. I showed you my S&P. I showed you my Tesla and United Health. Here's the critical part that nobody seems to understand with stock options, how I do it. I am not selling these puts secured with cash. I am selling these puts secured with my base portfolio right here. Now, many people are going to say, Brandon, how do you take assignment of your sold puts if the market goes down? I have my base portfolio and I always have my ratios in check. So let's say that I sell puts where I'm going to be on the hook to buy $200,000 worth of shares. Guess what? I have $1 million account, and say the market falls 50% somehow, say this account's going to be worth 500K, I still have 500K that I could generate, and I only have to take assignment of $200,000 worth of stock. So I always keep my ratios in check. And just to kind of hit this one more time and bring this home, if you're bullish on a company, if you're selling puts, you should be bullish on the company. So why would you ever want to secure that trade with cash? Like if you need $100,000 to secure the trade if you do a cash secured put, that kind of makes no sense if you really think about it, because if you're selling the put, you're bullish. So why not sell the put, take the cash flow, and then just buy the shares or something? Buy the shares or buy call options if you're really, really comfortable doing that. Like at a minimum, you should want to at least buy the shares. And if you're not willing to do that, if you're not willing to buy the shares, then I don't think you did enough research on the company. I don't think that you really understand what you're buying, at what valuation level. You don't really understand it that much. But hey, I am very, very picky when I do this stuff. 95% of the trades that I look at, they're all a no. You have to be very particular when you do this. You have to understand the valuation level that we're trading at, the macro, the micro, all this stuff comes together into a full package to really understand when the right time is to sell these puts. Again, at the time of recording this video, I think the market's a little bit expensive, and I'm being very, very careful with my sold puts. I think my sold put assignment value right now is roughly like 20%. So what that means is if my base portfolio were to fall 80%, which the S&P and the NASDAQ are probably not going to fall 80%, but if they would, I would still be able to take assignment of my sold puts. Again, I don't want cash sitting on the sidelines. I'm 31 years old. I am very bullish the market in the long term. The short term, yes, it's going to be very bumpy, but why not have your money invested in the market if you're bullish in that company? So if this doesn't make sense and you feel a little bit lost, you have to check out my 10-day stocks and options transformation. It's 10 days. You could do it faster if you want, but it's 10 days of detailed training of me walking you through step by step exactly every single thing that you have to know about my strategy from A to B, start to finish. Whether you're a beginner or an expert, it's going to transform you massively. On top of that, you're going to get access to my mastermind Discord community where you see all my trades in real time, my portfolio in real time, all my thesis videos, all my logic behind this stuff. Every single company that I hold in my portfolio, I have a thesis video on that and I update them regularly. So if you want to get started right now on a 10-day stocks and options transformation and the Discord community, click link below, come in, and I'll see you guys there. Welcome to the channel.